You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And today on The Biz, we're talking about par whole life dividends, part of our Competition Desk series with Brandon Roberts from the Insurance Pro blog.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone. I'm Steve Savant, your host of the Business Insurance Zone, and we're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And we're in our Competition Desk series all this week with us, Brandon Roberts, one of the top guns in insurance. I gotta say, Brandon, I'm really impressed, especially because you're about half my age and you know all this stuff already. And I'm thinking either you don't have a life or you really live and breathe this stuff. And I mean, you're all over the net. And you have your own blog, of course, Insurance Pro blog, which has its own cult following, I have to say. But then, of course, I blog out in main other areas that if they paid us for a little bit of commercial, I'd tell them who they are right now. But since they're not paying our bill today, I'm not going to do that. Maybe next time. But you're really all over the web, and we're talking about intel and I'm not talking about eutherical intel, stuff that we don't use in our practice. I'm talking about things we really need to know about. The last couple of shows, if you missed any of our shows Monday and Tuesday, you need to hop out to our site, www.brokersalliance.com. As soon as you come to the homepage, hit that red on-demand button and look at all the shows with Brandon and I, because we're talking about things that influence your practice, your ability to stay compliant, and the biggest issue is hey, I want to sell, but I have to sell right. Now, we're talking today about dividends, par whole life dividends. And the first thing I'm going to hear is that, email I'm going to get, Steve, why are we talking about an antiquated product? That was kind of like, okay, it was the precursor to everything we're into today, but is anybody really selling it? Well, I'm so sorry to say, par whole life is making a monster comeback. I mean, a monster comeback, and we're talking about dividends. Now, let's just let Brandon frame this. I'm not going to frame myself. What is a dividend? Because it's not a stock dividend. It's not like a dividend in stock. What is a dividend from a par whole life contract?
A dividend is a return of premium.
Well, is it a return of premium, or is it like, what did he say? A.O. Williams said it was a return of overcharged premium.
And technically, participating policies have the ability to put a little more margin in them in terms of expense in order to account for the dividend.
Yeah.
However, think about it this way. The 30-year yield on insurance company general accounts is about 9%, and we know it's 90+% bonds, so they're doing incredibly well with that. And so if that means I have to give a little bit more money to this policy, to this company, so that they can make a little money and return it to me, and over time I can kind of make money on that, that's what positive internal rate of return is when we look at the ledger, I don't really have a problem giving them more and getting that back.
So it's not so much a price, but I guess people argue the commodity argument, which is, well, I'm just looking for money in, money out. What did I pay for the death benefit? What did I get for the death benefit? And now I'm getting it kind of convoluted by income, dividends. It kind of messes with the basic premise of I just want insurance and pay for the cheapest price and get it done with.
Right. And one of the biggest problems is we have people who start quoting dividend rates, and that's where we get into trouble. And it's sort of vis-a-vis the stock dividend type thing. And the biggest issue that comes up, and I would love to just plead to the industry now to stop, comparing dividend interest rates and saying, well, mine's 7 and his is 6.5, so mine's better. That isn't true at all. We know nothing by virtue of looking at that interest rate. We can infer nothing about how better you are or how worse you are. We don't know what reserve we use to base that dividend off. We don't know if there's any additional expenses that we're not accounting for, the net versus gross debate. So comparing these rates and just saying, oh, look, do equal than, greater than, less than signs, we go with the better one. Not true. You got to look at a lot of different things. And
I'm wondering, how many portfolios does a carrier have? I mean, you say, what's the dividend rate? You're comparing rates. Yeah, but is it the same portfolio? I mean, some of these people start and stop a portfolio, begin a new one, and I'm going to say I know of a couple carriers that got thousands of these portfolios over the last 40, 50 years.
Right. So when they declare a rate, there is...
What rate is it?
Policies issued from this year to this year is this, policies issued from this year to that year is this, and policies issued from this year to current is this.
And, I used to go on ESPN to get the scorecard of the past on all the, at-bats, and they have all this technical, statistical issues. It's really great. For me to play at that level, I would have to go back per carrier, right, to pick off this per portfolio. to get that actual dividend.
If we're looking at historical numbers, which a lot of the mutuals love to show us, absolutely, we need to say, well, okay, you paid this IRR for this policy issued back in 1970 or 1980, but we can't even get that policy or that dividend rate today because you closed that book of business.
Yeah, in fact, actually, do you think there are any carriers out there, and this is a true question, I don't know, do you think there are any carriers that actually use a uniform portfolio, new money, new clients, old clients, they all get the same thing?
Everybody with the same rate?
Yeah,
there are some.
I think, do they tend to be better performers then because they're more universally stable in that regard in the way they price and reward the client for hanging in there?
There's certainly an incentive for them to be in that boat because they can't go to the old client, go to the old book and say, well, you know, that policy is over with, so we need to pump up the new dividend to make it competitive. Which means, so if they can't change it from block to block, they've got to pay everybody the same. So it gives you the incentive to keep the old policy.
I'd love to see a whole study on just that, portfolios that are universal to new and old clients, to see if those numbers and statistics are profitable not only for the company, but is it really good from a dividend at the end of the year, dividend payout. And when we talk about dividends, you know, we're talking about annual dividends. We're not talking about anything like terminal dividends, which are priced inside in-force ledgers and illustrations. Talk a little bit about that because I think that's confusing. Sometimes I think about the annual premium, right? But it's really, I got this other one too, this terminal.
Well, terminal's kind of gone the way of the dodo almost, though, because it's terminal dividends really are, once you die, we'll pay you a dividend. You won't see that a lot. The best, your closest you can get to it are people who say, okay, if there was a dividend due at the end of the year, we'll pay it.
Well, when I think about it, dividends are a crafty thing because it's in a black box that I can't unpeel and unpack and unbundle, which is the big complaint on whole life. But if the dividends pay, maybe I don't care. When we come back after the break, we're going to talk more about the dividend history, how the components work, and how they work in our policies today.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Companies in our business are always touting service, products, and underwriting. And we do that too. But here's the difference. Now enter the world of the elite producer with a value package that cuts us out of the pack. A BD that approves social media marketing of non-FINRA products and doesn't take an override. With the best competition desk in the industry, and for our loyal producers, a true group health plan. No one offers that. Brokers Alliance does.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant. I'm with Brandon Roberts, guru to all that is guaranteed issue. No, I was just thinking, you know, we're talking today about dividends, which is certainly not guaranteed. So I just want to go one step further and say, we have dividend history. When I'm looking at this, I'm looking at some stellar numbers, and one big glaring thing, especially when we talk about 20 and 30-year lookbacks on IUL, right? Everybody's always touting my 20 and 30-year look back. I just thought I'd do a 20 and 30-year look back on actual dividends paid. Not what they were projected, but what they're paid. I have to tell you, I was stunned, and I looked at this number, and I saw never in 30 years by all, and I have to craft this in my due diligence way, in the big blue chip mutuals, the big names. I saw no time in the last 30-year look back on actual dividends paid where they didn't pay something. I mean, that you know, you're comparing the IUL story is, well, we've had some bad boy years, but you won't get anything credited. You just won't get negative. I haven't even seen a negative year or a non-crediting year.
And now that old antiquated product makes a little more sense to everyone.
Well, all of a sudden I just did the 30-year notes, and if you are a theorist like I like to be, and I'm looking at S&P back all the way back into 1928, or I take the two Monte Carlo 20-year tranches, and I look at the total rate of return, and I'm starting to look up that against the 20 and 30-year look back dividends actually paid. I'm in shock that whole life actually beats those numbers. I mean, I'm in shock. And I'm not, I wouldn't call myself, and Brandon, you know me now, you think I'm a purveyor of whole life? You know, I mean, I sell everything, but I don't go out of my way. I was stunned by these numbers.
There's definitely a focus on returning some of the best dividends out there. Another thing to keep in mind is that legally, these companies do get audited, and they have to show that we had divisible surplus, we paid a dividend. There are companies who have settled suit where somebody went back and said, oh wait, there was a divisible surplus, but you didn't pay what you should have paid. And then everybody who had a policy gets a little check that says, sorry, here you go. So it's out there, and one of the only products out there that has a little bit of a legal requirement behind it to pay.
Well, when I look at the dividends, and I'm just taking the last 10 years, I didn't want to go too far back for the show, but I'm looking at one carrier, and by the way, this carrier is similar to the major blue chip mutuals that we'd always look at. This one carrier, when I compared their dividend history against the 10-year treasuries, they kill it. I mean, I was surprised at that.
Again, the majority of the general account is bonds, treasuries, really specifically, and these people know how to buy bonds.
Yeah, when you think about it, I'm looking at this. This is just one pie chart of one carrier, and I'm looking at how the dividends are determined by this carrier. And by the way, any of the things you say, Steve, I wish I could have that, or that, we'll send it to you. Just write me thebiz@brokersalliance.com, and I'm happy to send you all our material. It's all free, and it's all public domain stuff from our carriers. I love this general accounts where I'm looking at the vast majority of this is in bonds, as you suggested. Now, when I look at this, it's very conservative. I mean, if you look at this at asset allocation, these guys are not in stock equities. And by the way, a lot of them have gotten out of the mortgage business. I mean, there's still some mortgages here, but I mean, they have completely divested themselves out of a lot of real estate. Now, I have to say, with government bonds being so low, though, I don't know if that's all a great story, you know, but I guess it's relative to everybody else.
And they all hedge their bets.
And well, did they hedge? I'm curious. If we start having an interest rate market going up, then whole life might be a little bit slower to respond.
I think that's correct. I think there's a lot of people who are screaming for increasing rates, but what we have to understand is that if interest rates pop up because we have artificially depressed rates, we're not going to see corresponding dividend rates, and we're probably not going to see corresponding UL rates either. The problem there is they love to keep balance between their assets and their liability durations. And if we start to see rates go up, one, we're going to see a huge decline in their, well, not a huge, but a pretty good decline in their book value. And they're going to have a hard time rebalancing those durations for assets and liabilities. And so I don't think we're going to see dividends move like we would like to see them, not immediately. We'll see it catch up, but it's going to be a little underwhelming at first.
Now, when you said that, I got the whole life part of it, but you also included universal life in that statement. Now, tell me, I would have thought, no, that would be more flexible. You'll be able to get a little higher, a little faster acceleration.
It's possible, but the companies that are going to focus more on UL are going to treat those crediting rates somewhat similar to the companies that are more focused on whole life insurance or treating those dividends. And the problem's universal. It's all about balancing out those assets and liabilities. And when the interest rates go in weird directions, it hurts their ability to keep up with the rates they're paying.
Well, when I was looking at some of these rates, and again, I just want to point out, I'm looking at, of course, the 80s. I mean, look at these dividends that we're being paid. We're talking double-digit returns. And even as we got closer and closer to the 2000s, these were up in the high 8s. And so we didn't really get down to about 7.5. Somewhere around 2004 is when we started to see a real decline. But again, when I price this up against the 30-year look back on actual paid, I have to give them their due here. There's some numbers here. Now, has the paradigm changed so much that I can't really even think in historical terms? Is our globalization changed us? Has our own economic, which we're in they say we're outside the Great Recession, or we're at the front end of the second dip. I don't know which one it is. But what do we think? What do we think about that going forward, though?
Expansion in the economy is going to be a little tough, I would say. Those of us who are somewhat well versed on some more macroeconomic theories with steady state theory would tell you that we've probably had our big push up, and now we're going to see things trail off and sort of grow much more slowly. So historical lookbacks are going to be a little misleading.
Yeah, I think things have changed. I don't know if it's a paradigm change, but we're going to try to shift our illustration, our designs to agree with it. Well, that's all you have here for today on the Business Insurance Zone. Remember, you can hop out on our site, www.brokersalliance.com. As soon as you come to it, hit the red on-demand button. That's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, We're the news you can use.